Now let's talk about credit risk funds. Unlike floating rate funds, this is a very volatile asset class. I'll tell you why. The average return from this category in the last 1 year has been around 5.5%. The best performing fund in this category has returned 16.6%. But the worst performing fund in this category has actually delivered a negative figure of 27.6%. So imagine the swing really between the topmost performer and the bottommost performer. There's risk in the name itself of this fund. And you know what? This fund has been through tough times as well. It has been beaten down, especially in this last 2 to 3 odd years, not even in 1 year, since before the pandemic as well. What do you think, Mohit, is sort of bringing about this recovery in credit risk funds?
Look, so there are multiple reasons, Mubina, and as Shakespeare puts it, what's in a name, right? So if you ignore the name part of it, which is credit risk itself, you can actually look at fairly handsome returns from the category if one is willing to be a little adventurous in the debt allocation of the portfolio. Now, whether one should be doing that in debt allocation is a very, very different question altogether. To my mind, going for that 1%, 1.5% higher in debt, which is meant to be providing safety and security, ideally might not be the right choice for an investor, but it will again depend from investors to investors. Now, coming back to the main question, look, credit risk funds will typically invest almost 65% of their portfolio in corporate bonds, basically. Now, these corporate bonds are mostly AA plus kind of papers, and even below AA, a huge allocation, huge as in between 10 to 15 or 10 to 20 odd percent allocation also goes into single A papers in most of the portfolios. Now, if you check the yields on these papers, today a 5-year government paper is quoting at almost 5.69%. A 5-year AAA corporate bond is quoting at 6.1%. There's hardly any difference. But you go to a 5-year AA corporate bond, it's quoting at 9.25%. There is a 300 bips difference between a AAA and a AA corporate bond. And if you go to a single A plus paper, 5-year maturity, the yield is 10.25%. So there is massive yield catch up. There is massive yield swing between a AAA and a AA paper. And that's the reason this category has been very, very attractive. The yields are very high right now. These yields will compress. That will give additional capital appreciation in the portfolios. And even if the yields don't compress, the YTMs in the portfolios are very attractive right now for investors to get into, provided you are willing to take the credit risk on your portfolio.